Hey everybody, Marty Mazzora. Good afternoon, November 15th, 2016. For the first video this week, I thought what I'd do is would run through the slide presentation that we're doing in client review meetings currently. And the reason I want to do this is I think we touch on the important considerations based on what's happening today, what appears to be happening in the economy, the outlook given the new regime in Washington, and so on. So in front of you, though, first of all, the rectangled chart there is the New York Stock Exchange Composite Index, fairly current. I've had this maybe a couple of weeks, but it makes the point, and that is that we've been living inside of a real rectangle. Strategists or technicians would call this a consolidation phase. You can see we rose into it in 2013, and we're kind of living in this sideways pattern for a very long period of time. In fact, if you take about where we are, roughly maybe a little higher than that currently, you notice the NYSE is yet to recapture its all-time high like the Dow has done recently. But anyway, so we're back here. So you got to trace it back to early 2014. So that is a tough one, particularly if any new investors entered the market the last couple of years. Long-term investors understand it. It's not all that unique, as you can see here. Here is a look back to the 80s where we had these extended periods of kind of a sideways move. You could make this a channel, you could make this a channel, etc. It's not unusual to break out of these nicely to the upside. You can see that after we came through this consolidation phase, the market broke out, and 12 months later it was up 23%. Here's a similar look during the early 90s. A couple of these rectangles, if you will, consolidation phases broke out for a 15% gain after the last one. And then the mid 90s, we had longer periods, very long, again, 2+ years of sideways, broke out of it for a 36% gain. Now these charts are charts that I borrowed from an analyst. I created one of my own, and this one is MSCI All World Index. Now it's more US than foreign, like our portfolios are, but it's not as much US, but it's a good global index. And what I wanted to show here was I certainly do not want to give you the impression that we always break out to the upside after these consolidation phases. So here is a 2 years sideways look. The orange line I drew was basically I went here and went back till it hit, and that was 2 years earlier. So if you started here 2 years later, essentially not counting for any dividends or rebalancing, you didn't make any money. And then we actually broke out to the downside when the mortgage market blew up. Then we bottomed in 2009. We came out of it. We had a nice sideways, or I don't know if that's nice, we had a consolidation phase for, a good couple years plus, and then really broke out of it for some nice gains. And here's where we've been living today. I ran this chart yesterday. Again, the global averages have yet to recapture their all-time highs from last year. So notice the blue line. Again, I'm focusing so much lately on the 200-day moving average because that is considered, I agree, one of the best indicators of the direction of the long-term trend. Notice during this consolidation phase, it was rolling over, and sure enough, it gave us a signal that the market was going to give up the ghost, and certainly it did. Bottomed out here, and there are definitely, you can see where it rolled over here. We had that 2011, 15 or so % correction, came out of it. The 200-day gave a signal that looks like maybe better things to come. The market trading above the 200-day is very important as well. Then we get into the sideways pattern where you can see it was support. It ended up being support resistance for a little while and so on. Then we had that 2015 correction, first one in 4 years. And then we had the Fed raise interest rates, and you can see the 200-day was sloping, but it didn't create a bear market. It was a correction. Right now, testing that 200-day moving average and then basically bouncing off of that is hugely positive from a technical perspective, and the slope looks pretty good. So this looks a lot more like this and those other charts that I showed you than it does that. So that would be an optimistic technical view of the trend going forward. So the Fed in December, Fed funds futures as of yesterday, we're discounting a 92% Fed rate hike. As you can tell from current market action, there doesn't seem to be too much worry about that roiling the markets, but it's something people worry about. I had a client yesterday who said, oh my gosh, because You remember that what happened last year after the Fed raised interest rates right about here, the market took a big dip. I think I've shown you this on a video already. I've showed it so many times to clients. Maybe I have, maybe I haven't. But if I have, forgive my redundancy. But this was the setup a year ago. This is the 200-day moving average over the 50. That's a bearish, kind of a negative setup. That's where we were, sitting where we are today. We did see kind of a rally on a short-term basis, maybe some hope, but you can see that surpassing the 200-day didn't last very long. The 50-day moving average is going to be a lot faster, more sensitive indicator. Technicians call this the death cross when this goes below the 200-day, the golden cross. This is not the best indicator out there, I'll tell you right now. For long-term investors, I would just focus more on the slope. But it does add to kind of the setup. You can see the 200-day was really flat going in here, and we had that worst start to a year in history, as they say. You can see as we came out of it, the 200-day began to slope higher again. The 50-day is comfortably above that and is beginning to turn positive as well. And this is the S&P 500, by the way. You can see it bouncing strongly off the 200-day. So this is a technical indicator. Of course, anything can happen. The market could certainly fall out of bed after the Fed rate increase. But this is a technical indicator that suggests probabilities are that if it happened today, that we are likely not to have quite the dramatic sell-off that we had at the beginning of this year. Okay, so sector by sector, real quick. I'm going to start with the cyclical sectors. This would be what the market is telling us about the economy, and this would be technology. Notice it trading up nicely above the 200-day moving average, and the 200-day moving average sloping very nicely to the upside. These charts I updated yesterday. So that says positive things about the look as the market would suggest going forward. Here is industrial stocks. Again, huge bounce on the prospects for infrastructure spending. We started talking about that 3 or 4 weeks before the election. I said that whoever wins, there's some pent-up demand for infrastructure spending. You can see industrials have really broken higher to the upside. Materials would be another obvious play. You can see materials have quite a bit of ground yet to make up to achieve their all-time highs once again, but a really nice bounce at a very favorable looking 200-day moving average right now. Energy is staying above the 200-day moving average. That slope is very good as well. Very cyclical sector, energy. What have I got? Financials. Financials is something that I've talked about ad nauseum in meetings and even here on the blog. We have our highest allocation to financials. Here was the peak. You can see we've got a lot of daylight to catch up. This is a very good look. Speaks to the potential for the economy doing better, the potential for higher interest rates and better net interest margins for banks and so forth. So another play on a growing, inflating economy. Consumer cyclicals have had a really nice run. Amazon is a big part of the index. We use the XLY, the Consumer Cyclicals Index Fund. Valuation's got a little suspect in here. You can see some profit taking. Recapturing the 200-day and it's sloping higher, I think, speaks to the possibilities for the sector. It's not a huge weighting in our portfolios, but it is something that we have a 10% target to currently. Okay, so then we get to things like communications services. So you get your AT&Ts and Verizons. This is a global ETF that we use. I particularly like non-US communications companies, China Telecom, for example, et cetera, because they're going to be big players in emerging market infrastructure. That said, they're considered defensive. People buy them for the dividend. Therefore, they have just really been taken out here lately. The 200-day still looks okay, but trading below it would be bearish right now. Consumer staples, again, the 200-day still sloping in the right direction, but definitely gave it up and then found it as resistance. Makes great sense to me. We had a really good run. Clearly, we're seeing money rotate out of consumer staples into the more cyclical things like materials and industrials and so forth. Okay, healthcare. Healthcare is a defensive sector. You can see it had a very good run. We could talk about the Affordable Care Act and what that did for medical technology and medical equipment makers. This would be a nice bounce, a lot of it on pharmaceuticals, on biotech companies and so forth. Recapturing the 200-day moving average is a good thing. I'm still going to view it as defensive. We have an 8% target actually in healthcare in our portfolios. Utilities are getting utterly creamed. Makes sense to me. We have a 0% target to utilities, very interest rate sensitive, very defensive. We won't be looking at utilities again until we think the economy is peaking and interest rates are a lot higher, ready to come lower. Okay, so non-US, I've been preaching the virtues of global investing for a long time. The election did not help at all non-U.S. securities. You can see the sell-off here recently. Europe Australian Far East Index is doing battle with the 200-day. If Trump walks back, a lot of the protectionist stuff that I have suggested here, and I believe this passionately, would be very bad for our economy as well as others, then there's some value there. In fact, the setup is good, and I'll have a little more on that in a second. Europe, the Eurozone, the Euro Stoxx 50, you can see the 200 days looking a little better. The economies in Europe right now, as of the indicators that we track daily, are really beginning to look better. A lot of uncertainty right now, kind of a battle going on with the 200-day moving average. Emerging markets were far and away our best thing going this year. They have given up the ghost, although they were up today. They had a nice bounce off of that 200-day moving average. I like emerging markets. I think we got to own it over the long run. But right now there's a lot of uncertainty over the strength of the dollar and capital potentially outflowing. We don't have a huge allocation there, but it is something that we want at least a little bit of in every portfolio. Okay, so bullishness. I've shown you this a lot lately. Huge spike in bullishness last week. And a lot of this is actually before the election, so it'll be interesting to see what this week's bullish indicator looks like. So 39% is a huge jump. I like it when it's lower. The market tends to do better when it's lower. Here's a quick look. So we right here in that 30 to 39%. Here's how the market hit over the last 30 years has looked. About 12 months out, we're still looking at about a 10% return. A few weeks ago we were 20. A few months ago we were under 20. We've had some really nice gains since then in the S&P. But even now, this is not a bearish indicator by any stretch. It's when you start getting 50% and above is when I start getting nervous about too much optimism in the market. And cash levels, I talked about this I think already. Funds very high in cash relative to where they've been. The purchasing managers indices for Europe are all in expansion mode. That's something that I like relative to our European exposure. The last manufacturing PMI for the U.S. at 53.2, above 50 is expansion. You can see the highest estimate was 51.7. This morning's New York area manufacturing index, the Empire State Index as they call it, was higher than expected as well, and retail sales were much better than expected. Household net worth, the U.S. consumer is richer than he or she have ever been, and they're really, really looking good from an income statement perspective. This is the discretionary income relative to debt. You can see where we peaked. If the U.S. is 2/3 consumer, the consumer is very healthy. Healthy as probably we've ever seen them, at least since, I guess, 2012. Consumers have been very, very frugal, high savings rates since the Great Recession. Wages are looking up. Here's the latest wage data. That's a very good look for a consumer-driven economy. Okay, so politics real quick. We have Republicans controlling Congress, and we have a Republican president. I talked a lot leading into the election that the market was looking for this. Gridlock with a Democratic president since 1901. That's been the best combination for the market. If you got to have all one or the other, historically speaking, a Republican administration's been a little bit better for the market too. I think that's created some solace for nervous investors. 13 times historically where we've had Republicans controlling both houses and the presidency. We've had 10 of those periods where the market has gone up. The 3 since World War II, the market has gone up as well. This is just a repeat of what I showed you. The market's done okay when we've had all Republicans. So again, this absolutely is in no way, shape, or form a political statement on my part. This is just showing you what traders who are sensitive to politics are looking at historically. The rhetoric, which I believe is more than rhetoric, on infrastructure, hopefully on corporate tax reform and regulatory reform, is very market friendly. The protectionism is unequivocally unfriendly to markets. That's something he's going to have to walk back for this market to continue to look good. And I do think the setup is good right now. So I'll leave it there for now. That was a long one. Thank you for hanging in there, and I will be back very soon. Take care. Bye-bye.